Gold is strengthening the BRICS currencies at the expense of the dollar. In case you haven't seen the ECB Financial Stability Review, drawing attention to the unallocated paper gold to physical imbalance, identifying large foreign counterparty derivative exposures that must be brought back into essentially rising prices. So the only question left to ask our dear subscribers is, how prepared are you to protect your wealth from the next leg of the dollar and related fiat debasement? How much physical gold and silver do you own right now?
Andrew Maguire, a British trader who exposed manipulation in the gold and silver markets, states that gold is strengthening BRICS currencies at the expense of the dollar. He points to the European Central Bank's Financial Stability Review, which highlights rising concerns over the imbalance between unallocated paper gold and physical gold, as well as significant foreign counterparty derivative exposures that must be bought back, factors contributing to rising gold prices. These market imbalances support gold's strengthening effect on BRICS currencies. The potential impact of a new BRICS currency on the US dollar remains uncertain, with experts debating its potential to challenge the dollar's dominance. However, if a new BRICS currency was to stabilize against the dollar, it could weaken the power of US sanctions, leading to a further decline in the dollar's value. This connects to Maguire's observations about gold strengthening BRICS currencies while the ECB's derivative exposures pressure traditional financial systems. Gold is regaining its status as a global monetary asset, with the European Central Bank recognizing its safe haven appeal amid economic and geopolitical instability. In a recent paper, the ECB noted that, unlike most bonds and equities, gold does not generate cash flow. This ECB acknowledgement reinforces gold's role in strengthening BRICS currencies and challenging dollar dominance. Andrew Maguire says silver in the foreign exchange market is priced higher than futures, so it's being locked in at a premium. This suggests the July COMEX silver contract will likely be used for delivery, which could remove up to 6,000 tons of available silver from the market. This removal would reduce futures market supply. Silver futures and options offer a way to manage risk effectively. These contracts are traded in January, March, May, July, September, and December, within a 24-month period, with each contract representing 5,000 troy ounces of silver. The premium pricing drives traders toward actual delivery rather than cash settlement. Focusing on the July contract cycle, physical delivery reduces available silver inventory, potentially widening the premium between physical and paper silver prices. Before we begin, don't forget to like, share, and subscribe. Only 2.6% of viewers have subscribed. Join them today by clicking that button and turning on the notification bell.
Spot silver is trading at a consistent premium to silver futures. That shouldn't be happening. Currently today it's 6 cents, but it's been as high as 12 cents or $600 per contract. Now, given though through the last 4 sessions, silver open interest has evidenced 9,682 or 1,500 tons rinsed out, even averaging the spot premium to futures at, say, 6 cents, that's close to $3 million of house positions that have been rinsed out by the pit managers. That's the game. This is telegraphing foreign exchange silver is being locked in, though, because the foreign exchange price is higher than the futures price. Because it's being locked in at the FX fixes to future at premiums. And it also indicates the imminently expiring July COMEX silver contract, which goes into delivery at the end of June, will be stood for delivery and will be drained of cheap, immediately accessible silver and the current open interest that remains. So the potential delivery exposure right now is a very large 6,000 tons. And while a lot of these positions will, of course, they'll be rolled into the upcoming September contract, there are only 2 sessions left to actually deliver the last 1.4 tons of June deliveries. Why the heck anyone would hang on to the last day to deliver a June delivery that should have actually been delivered at the end of May? So to sum up, basically, both of these bid pulled efforts in gold and silver are options, OCC related ahead of options expiry today and OCC related capping And it's being led by Citi, stick-handling official OCC bets. And while we expected a last kick at the can ahead of US Basel III compliance, all it has achieved is to secure the next higher, globally determined, higher price stair-step with almost no paper speculators on board to rinse. Just to finish up, though, we have contacts on the ground and we'll be closely monitoring the upcoming 17th BRICS summit in Rio on the 6th and the 7th of July. And we're going to provide a full update in our last episode that will be recorded on the 9th of July. So BRICS, remember, is a platform for accelerating financial multipolarity with a view to expanding the new development bank so as to bolster national currencies in intra-BRICS trade benchmarked to gold. That's the key thing. And with gold markets now being discovered in Ava, prices now being discovered in Asia, as Bloomberg draws attention to, it provides the BRICS autonomy. Gold is already being price discovered in the Eastern physically backed markets. The formalizing of the financial infrastructures to support liquid global settlement is the final piece of the puzzle, and it will be the death knell of the COMEX if it does not become Basel III compliant. We've talked about it before. Yeah, you can avoid being Basel III compliant. You can keep playing your paper game, but you've got less and less people to actually cover your exposure into. So you're in trouble. And simply what happens is you're going to influence the fixed price through your COMEX gaming, and that's going to be delivered. And then they're going to turn around on you. And what they're doing in silver right now is loading up at the back door and taking it and literally draining those vaults. So unless it becomes Basel III compliant, goodbye. Now, gold is strengthening the BRICS currencies at the expense of the dollar. In case you haven't seen the ECB Financial Stability Review, drawing attention to the unallocated paper gold to physical imbalance, identifying large foreign counterparty derivative exposures that must be brought back into essentially rising prices. So the only question left to ask our dear subscribers is, how prepared are you to protect your wealth from the next leg of the dollar and related fiat debastements? How much physical gold and silver do you own right now?
Andrew Maguire clarifies that gold itself isn't rising in value. It's the purchasing power of fiat currencies that is rapidly falling. Regardless of the currency, more newly printed money is needed over time to purchase the same ounce of gold. This shows that gold serves as a benchmark for tracking currency debasement across any time frame. Gold isn't truly rising in value, it's the purchasing power of fiat currencies that's falling. Since 2007, gold has surged by about 400% across most major currencies, with gains ranging from 238% in Swiss francs to 651% in British pounds. This reflects how currencies have lost nearly 80% of their value against gold. The consistent nature of this phenomenon across different currencies demonstrates the universal debasement that Maguire describes, where increasing amounts of newly printed money are required to purchase the same ounce of gold. For over 6,000 years, gold has remained the most trusted form of money and a reliable store of value. Let's get back to the video.
Value gold, as a consequence, value gold literally hundreds to thousands of dollars higher than is currently being offered for sale, because it's being offered for sale in a diluted form. And it's not that gold is actually going up. It's simply that the same ounce of gold, the ounce of gold benchmarks really the loss of purchasing power of no matter what currency you're in, the full range of rapidly debasing fiat currencies. Now, each day, each month, quarter, year, decade that goes by, it simply requires more freshly printed dollars to buy the same ounce of gold. That's really what's happening to gold. Now, in contrast, highly leveraged casino gold speculators, and they're literally corralled inside the COMEX casino, and they have US traders have no ability to trade the spot delivery physical markets. So, in consequence, they have no visibility into the real wholesale market supply-demand fundamentals, whereas the house does. So with this knowledge, the house knows exactly how many chips to lend to create enough liquidity to set a non-deliverable casino ticker price for gold. You know, when you're in a casino, you see a ticker price going on. It could be racing, it could be anything. I mean, that's their number, that's their presentation. And this is how the cartel generates regular wash and rinse cycles. And that's something we're seeing now, which is why this question is pertinent. Now, given the casino pit managers hold the book on the chips borrowed from them on margin, and the house runs this ticker the specs actually knee-jerk react to, in aggregate, the house market makers know exactly where the speculators will be forced to sell their positions. And just like any other casino setup, the house wins 95% of the time. And as the LBMA CME market makers act as a cartel, it's really sanctioned wire fraud by any other name. Now, while there are legitimate reasons for trading futures contracts, that could be to trade physical positions, producer or refiner hedging, these bets are not speculative and tend to be sticky in nature, and they're not to any degree asymmetrically imbalanced. It is a legitimate hedge, meaning that these positions, which is part of the open interest, which is why you have to look at the breakdown of it, they're not leveraged and they can't be rinsed out, but they can be called on for one-to-one physical delivery at any time, which is something we see sometimes at the back door of the COMEX. However, what we're focusing on, we're actually going to focus, we're really focusing on the leveraged speculators who are simply seeking to profit from price movements for cash settlement. Usually they're on the long side. So it's this simple. Once speculators have borrowed enough chips and the price jumped on for the right evidences the house is on the losing side of that trade, they move in. But this is the key, in unison, because they're market makers and they have a footprint in the FX spot markets, which COMEX traders can have no visibility into or are unable to trade, and they have a footprint in the COMEX. So, but in unison, they can ring the register on these borrowed positions, or as Doug rightly puts it, the exact point where speculators can be margin called by the pit managers to replay these borrowings.
Gold and silver continue to expose the fragility of fiat currencies, with strong physical demand outweighing the influence of the paper-driven market. As global markets move toward greater transparency and physical settlement, the real value of these metals is becoming more evident. In an environment shaped by aggressive monetary policies, many investors turn to gold and silver as protection against currency devaluation. Can silver's unique blend of industrial demand and monetary value drive its outperformance in the next bull market? Let us know your thoughts in the comments below. If you enjoyed this video, don't forget to like, share, and subscribe. 97.4% of viewers haven't subscribed. Be part of the 2.6% who have by clicking that button and turning on the bell icon. Thanks for watching.